Hi, I'm Ryan Levine with Utah Working Capital. Now I'd like to talk about how to analyze a balance sheet. A balance sheet can be analyzed in many ways to help investors, bankers, or even a manager understand what the true value or performance of his company or business is. There are 4 key ratios that can be derived from the balance sheet. First, liquidity ratios. The first type of liquidity ratio is the current ratio. This is taken by taking all of the current assets within the company and dividing it by total liabilities. This helps an analyst understand how well the cash, the inventory, and other investments can be turned around specifically into cash to pay for any liabilities that are outstanding. The second liquidity ratio is the quick ratio, which becomes even more specific. This takes the cash as well as short-term investments plus accounts receivable, divide that by the total liabilities, and it gives an analyst even better insight into how well a company can pay for its debt. The third liquidity ratio is the cash ratio, which is simply just the cash divided by total liabilities, helping somebody understand how quickly a company is able to pay for their debt. The second set of ratios are debt ratios. These ratios are meant to help people understand how much debt the company has and whether it's a healthy amount. The first ratio is the debt ratio, which is calculated by taking the total liabilities and dividing it by total assets. This helps an analyst understand if the company has too much debt or can possibly take on more debt given the current amount of assets that it has on its balance sheet. The second debt ratio is the debt-to-equity ratio, which helps investors understand how well the invested capital of a shareholder is being used and the likeliness of them to receive the investment based on the given amount of debt that a company has. The third set of ratios are profitability ratios, and these are built to help analysts understand how well the company is actually making money based on the different facets of its balance sheet. The first specific ratio is the return on assets ratio. This is calculated by taking net income and dividing it by total assets. This helps people understand how well the company is taking its assets and converting it into direct profits. The second profitability ratio is return on equity. This helps shareholders understand how well their invested capital is being utilized and how efficiently it's being turned into profits as well. The fourth type of ratios are investment valuation ratios, and these are designed to help specifically to investors to help them understand exactly how well the company is performing and how likely they are to get a specific return on their investment. The first is the price-earnings ratio, and this is calculated by taking the stock price per share, dividing it by the earnings per share. The second ratio is the dividend yield. The dividend yield is calculated by taking the annual dividend paid and dividing it by the stock price per share. This helps an investor understand how well the company is paying dividends based on the investment that they put into the company. For further additional questions, contact us at utworkingcapital@gmail.com.